And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is Monday as we roll into the second week of June, and a couple of things that are going on right now. Of course, this week we've got a lot of the more important, right? So we had the employment report last week. We'll have inflation data this week. So kind of all markets are just kind of waiting for that data to come out. And again, it's because what's the Fed going to do, right? Everybody's looking for this one piece of economic data that's going to somehow magically unlock the keys to the kingdom for the Federal Reserve to start cutting rates, and that's going to help support markets and drive markets higher. And that's the hope anyway, and that's why markets have been rallying a lot as of late, is this expectation that's coming. Weaker economic growth is not really good for the economy, but hey, it's good for getting Fed rate cuts. And it's just kind of the nonsense we've gotten ourselves into as market participants, in a way, just looking for the Fed to bail. When's the next bailout? And of course, it's something that's been going on for 15, almost 20 years now, as we continue to kind of roll along. But you know, we've gotten so used to having Federal Reserve interventions and things like that, and that's why it's what's really interesting is when we come down to talk about interest rates. Interest rates are at 4.5%. Oh my gosh, interest rates are so high. They're not, really. 4.5% is a normal interest rates. We were at 5% prior to 2008. I mean, so we're not even back to where we were in 2008 in terms of interest rates. The problem was we got used to abnormally low interest rates for so long. You know, being able to finance a house at 2 or 3% is ridiculous. You should not be able to do that in any environment. And then you wonder why, everybody's wanting these lower interest rates, but then you wonder why housing's so elevated, right? Because you spent so long with such low interest rates. Everybody was buying houses that really shouldn't buy houses, right? I mean, not buying a house is not a right. It's something that you financially grow into over time. And, if you work and you save and you do all the right things financially, yes, you can afford to buy a home. The home is, buying a house is not the American dream. That is the representation of the achievement of the American dream. I've become successful. I've built a business, or I've got a good job. I've saved money. I've invested well. Now I can afford to buy a house. But when you dropped rates to such a very low level, all of a sudden people were buying houses that really shouldn't have bought houses. Now they can't sell them because they've got nowhere else to go. They can't qualify for another house. And so this is why we've got this locked up inventory right now in the markets, and that's keeping prices elevated. But this is just part of that financial manipulation that happened over the last 15 years, and these are the consequences of those actions. But investors got very, very used to low interest rates and all the benefits that came from that, from rising stock prices and everything else. So now we're wanting that again, right? But the consequences of ultra low interest rates really aren't good, and long term, for a whole lot of reasons, economically more than anything else, creates wealth gap disparities, etc. But again, this is where we're trapped into the cycle right now. We want lower rates to help push markets higher, but markets are doing just fine without lower rates. And this is one thing that we talked about before, is that if rates stay at this level, will normalize to this level, the economy will do fine at 4.5% interest rates. That is not an onerous level of interest rates. As long as interest rates don't spike higher, that's what breaks things. But if rates just kind of stay here for a while and just kind of grind sideways, the economy and the markets and everything else will get used to being at 4.5% interest rates. That is a normal rate. The Fed funds rate is about where it should be relative to economic growth and inflation. So again, things are not abnormally high here. They just feel that way because we spent so much time at near zero interest rates. Now, again, will the Fed come in here and cut rates? Yeah, they will. It'll just be a given time. They'll cut rates 2 or 3 times this year, maybe. Maybe they won't cut till next year. Just depends a lot on the economic data. But the employment data is clearly showing the economy is slowing down. There will be a point here soon that the Fed comes in to cut rates, as they will, to help support the employment market, et cetera. The byproduct of that will be a very excited stock market. But that's where it is. So this morning we're going to spend a little bit of time talking about how to buy the dip. This is the big question, right? That I get a lot. It's like, you're buying stocks here, but how you know you're not catching a falling knife? Well, there's some ways to kind of look through that. We'll get into that this morning. But let's talk about the markets. Here's what you need to know before the bell. A lot of emails over this weekend, still concerned about the next shoe to drop in the markets. We're going to have this, this is just the rally. It's a bear market rally still, etc. It's not really a bear market rally. We had a correction. That correction is now over for a whole lot of reasons. But again, when we start to step back from kind of the daily, price data that goes on and start to look at weekly market data, we get a little bit better sense of what's actually happening in the markets. And again, we're seeing a lot of improvement from where we were just, a couple of months ago. This is a weekly chart of the S&P 500. Let me explain to you what I mean by this. So we were extremely overbought on a momentum basis for a very, very long time. During this whole rally heading into this year in particular, this market was extremely overbought and pushing higher, but we just had a lot of excitement in the market. So we had 20% year coming off of October of 2022. We had a 20% return of the year last year, so exuberance was high. It was all about AI and everything else is going on. So markets can and do stay overbought for a very long period of time. And as we started getting into early February, we started warning about, hey, we're really overbought. We're starting to see some cracks in the markets. Be a little bit careful, reduce risk. We talked a lot about this on the show. We then triggered that sell signal, and then we had this correction. That correction worked off a whole lot of this overbought condition on both a relative strength and a momentum basis. We got oversold on both of these bases. We've now turned that back up, and we've now triggered a buy signal on a weekly basis. Again, this is a slower moving indicator. So by the time it triggers on the way back up to confirm that this low was the low, you start to see a better outlook for markets. And again, we're seeing, rising relative strength here. That's good news. We're not extremely overbought yet. We're getting there. We're going to have a correction here at some point this summer. It's just a function of time. When we get there, we'll see. Now, but again, with this weekly buy signal back in place, that suggests that the next market move is going to continue to be higher. Yeah, we could have some pullbacks here to support, and there's plenty of support levels between the longer-term moving averages and the shorter-term moving averages. Got a lot of support building right around 5740, but you could pull back to around 5500 on the S&P. That wouldn't be surprising, but a corrective pullback is going to be another opportunity to add exposure as long as this buy signal is back in place. And again, if we just go back through history and take a longer-term look, what you'll see here is that the long-term moving average has been running support for this market, ever since 2008. Every time we've come down, here's the pandemic, here's 2018, here's October 2022, here's the correction we had in October of last year, and then of course this recent correction, have all come down, tested this longer term support. And whenever you've triggered these buy signals from very low levels, those have been good entry points for the markets. And again, we just had one of those events. So as investors, the upside to the market here now outweighs the potential downside. Yes, you're still going to have corrective pullbacks. That's just part of the markets. They go up and down over time. But the trend of the market is still positive. The bullish market is still intact. The trend is still positive. Your momentum and relative strength indicators are improving. That all suggests that probably the next stop for the market is going to be all-time highs before we go down. And that's the greater odds here than a much bigger correction to the downside, even though there's a lot of people still thinking that's still coming. That risk has now been greatly mitigated over the course of the last month or so. Anyway, that's what you need to know before the bell this morning. We'll come back and talk a little bit more about how to buy the dip, how to know the difference between buying the dip and catching a falling knife. We'll talk about that next on The Real Investment Show.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So one of the questions that I get during market corrections, right? So, back on April the 7th, we wrote this article called The Hope and the Fear, talking about that this was probably the bottom of the correction. And of course, that elicited a lot of emails like, no, this correction is just getting started. It's going to go a lot lower. So the question I get a lot is, how do you know the difference between buying a bottom and buying a falling knife? And that's always the bigger concern, right? So a price is, the market's coming down, so you think it's the bottom, so you buy it, and then it just keeps going down. And that happens sometimes. And the truth of the matter is that we never know exactly where the bottom is, and nobody does. But as investors, we do, as we've talked about so many times on the show, is that we do exactly the opposite of what we should do as investors, is that we buy high. When markets are going up, it's like nobody ever talks about, how do you know you're not buying a rising knife, right? When markets are going up, it's always okay to buy when markets are going up. There's never a concern about buying at the peak of the market, right? It's like, markets are going up, got to buy. So that's why we buy high. Conversely, when the markets are going down, everybody's scared of buying because it might go down more. It's the fear, it's that behavioral bias of loss avoidance that we have. It's like, we don't want to lose anymore. We don't want to lose money, so we don't invest. So this is why we consistently buy high and we sell low. But as investors, that's exactly what we want to do. We want to sell high and we want to buy low. The problem is combating that fear of not buying the bottom. And this is always interesting to me because our job is to buy lower prices so that eventually when prices rise, and they will, that we actually make money on our investment. And so a lot of the concern is just very simply is that when markets are declining, you buy. And if it goes down more, you buy some more. And if it goes down some more, you buy some more. You look for opportunities in the markets to buy things at a cheaper price. The problem is that as investors, we've turned this into a competition where it's like, I've got to buy the exact bottom. Well, you're never going to buy the exact bottom, most likely. I mean, you may get lucky, but you can't consistently do it. And you can't sell the exact top, right? But we don't want to sell tops because we're afraid of missing out that the markets might run up without us. So we won't take profits. We won't do the other things that we need to do. So these are just all these behavioral traps, these fears that we get ourselves wrapped up in that lead us to making, decisions that lead to poor outcomes over time. But there are some things that we can do to help improve our odds of navigating markets better. And there's really just kind of two tools that we want to focus on in today. And by the way, this article is on the website right now at realinvestmentadvice.com. It's also on our Substack page at Lance Roberts. So if you subscribe to Substack, you'll get notified when I post these articles. But this article came out this morning talking about buying the dip and how to know when to do it and some tools that are available that you can use to do this. Now, I'm going to go through the tools that we use and, internally to help us make better investment decisions. But these tools are in various forms. Not the particular tools I'm going to cover today are our tools. But there's versions of these tools everywhere. So again, if you don't want to use ours, you can use your own. You can come up with your own structures. It doesn't matter. But the idea is the same. And so we're going to talk specifically about two things, importantly, that can help you identify when you're nearing a market low versus a correction that is still in process. And that's really kind of the key difference here. How do you know when to buy the dip? That's the big question. Well, the first thing is of course sentiment. Sentiment tells you a lot about markets. Because, again, what is sentiment? It's the fear and the greed, right? So when markets are rallying and they're at all-time highs and people just can't wait to buy, sentiment gets very, very overbought. And sentiment gets very elevated, very bullish. And when things are extremely bullish, that's where the question becomes, well, if everybody's bought, who's left to buy? As Sam Stovall once said. And so when you start getting to very, very high levels in the market, optimism-wise, that should be a bit of a warning sign that maybe you should take some profits, rebalance some risk, wait for a better opportunity because it will change. Now, it may not change tomorrow, and this is the trap that we get ourselves into as investors is like, well, I took some profits today in Microsoft, and then Microsoft goes up tomorrow. It's like, oh my gosh, I sold too early. No, it's okay. It's okay to leave some meat on the bone for somebody else, right? You don't have to sell the exact top, but that's that competition that we get ourselves into with the markets. It's like, oh man, I left money on the table. I could have just, if I would have just held it, darn it, I'm a terrible investor. But that's okay. Again, it's okay to take some profits. You still have a position in the portfolio. All you do is reduce it a little bit, took some gains off the table. Your stock's still going up in price. That's okay. Eventually, it's going to stop going up in price and it's going to go down in price. And then you take that cash that you harvested and you put it back to work, right? But this is the competition that we get ourselves into. And it's more of a competition with ourselves, but it's also a competition with others, right? We talk to our friends, talk to our neighbors, and they was like, oh yeah, I own Microsoft and had a great day today. It's like, darn it, I sold some of mine. And, one of the problems is one of the misunderstandings comes along is when I say take profits, people sell everything. And that's not what we're talking about. Different article for a different day. We'll get into risk management at some point. But this is markets and sentiment. And so one of the tools that we look at very closely is a gauge of market sentiment. And we can measure sentiment in multiple manners. And again, how we do it and how you can do it are two totally different things. It doesn't, and you can all get to the same eventual spot, right? You can just look up the CNN fear greed gauge. It's. I don't like that gauge. It's okay. It works. I don't like it particularly because it uses the S&P to measure the S&P, which is kind of redundant. But we built our own fear greed gauge for this purpose, but it looks specifically at allocation. How are investors, both professional and retail investors, allocated? Do they have money in equities or not? What's volatility doing in the market? Volatility, the fear greed index tells us a lot about the market. Put call ratios. the percent of stocks on bullish percent buy signals. These type of indicators, we compiled all this into a single indicator to give us a market sentiment gauge. Now, this is a couple of weeks old, but it's you get the purposes. Don't look at where the gauge is right now, but look at the history. What you'll notice is that historically, when this gauge gets to very, very low levels, and when we start getting this gauge down really below 20-ish, that's been a really, really good. Sorry, it's a 20 below 30. Sorry, my bad. But below 30 on this index is a really good indication that you are approaching or near market lows. Conversely, when you're above 80 and really above 90, you're typically very close to a market peak. Now, right now, we're kind of middling in the range. Now, one thing about indications, and particularly with sentiment, is this is about herd behavior. Herd behavior tends to be right in the middle. They're wrong at the extremes. And this is why these indicators are so important to help you identify when markets are near market peaks or market lows, because those are the extremes. In the middle, you go with the herd. When these sentiment indicators are kind of in the middle of the run, between 30 and really 70, that kind of middle range, going up or down, follow the herd, because they tend to be right in the middle. They're wrong at both ends, right? That's the fear and greed. So again, that's one thing. So we're talking about sentiment in this position, right? Or in this particular case, we're just talking about how investors are acting towards the markets. How do they feel about it? How are they allocating? How are they doing that? Because again, that's a really good indication of the markets. Now, the flip side of this is we're going to talk about price, because price is the representation of that sentiment in the markets. Now, a lot of people poo-poo technical analysis. It's all voodoo, right? It's just, prices don't tell you anything. What prices represent every single day, every single second, is what the market is doing. It's a representation of market action, of what all the buyers and all the sellers are doing. That's what prices tell you. So again, we've got sentiment on one side telling us what they're doing. On the other side of this equation, we've got price, which is the representation of their actions. Now, these indicators, if you want to use our indicators, they're all on SimpleVisor. So if you go to simplevisor.com and you go to the markets tab under sentiment, we actually show you the long-term history. Brent, you can bring this page up for me. But you can actually track these sentiment indicators. That goes back 3 years, so you can kind of see where these indicators are. We have about 6 different indicators on this page entirely that are all representing market breadth, sentiment, positioning, etc. But again, these are all, if you want to use our gauges, we publish them on a real-time basis on simplevisor.com. Now, when we come back, we'll talk about price, and we'll talk about technicals as a tool to help you identify when you're approaching a market low versus a market within a process of a correction. Don't go away, more of this coming up right after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors, online resources, and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interest first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
In the chat, they've been going on about first PCs.
Yeah.
And if you had a PC with a floppy drive.
The Real Investment Show podcast.
My first actual quote computer was a Tandy 1000 with dual 5.25-inch floppy drive and a whopping 512K of memory.
Same show, your schedule.
I felt so fortunate in college in my dorm room to have my own computer,
Right.
with my own printer.
You were a spoiled rich kid.
Well, I don't know about that.
At realinvestmentadvice.com.
Instead of being in the bar going, hey, what's your major? He's like, hey, I have a computer with a printer.
Why don't you come check out my dot matrix? That's right.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now, with the new and improved Before the Bell report. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. So talk a little bit about buying the dip. And, we just finished talking about investor sentiment, which is how investors feel about the markets. And again, the reason sentiment is important is because it's a contrarian indicator. From a basis when everybody's bullish, that's the time to be bearish. And when everybody's bearish, it's time to be bullish. And that's just the basis of it. It's a reflection of herd behavior. Market psychology, of course, is a big driver. And, timing of entry and exit points. And if you take a look at, if you go, for instance, go to SimpleVisor, look up the sentiment gauge under our sentiment page, you'll see that market peaks occurred in that index. It occurred in 2007, 17, 2019, and 2021. Every one of those were the peaks of the market. Conversely, the lows showed up in 2009, 2011, 2016, 18, 20, 2022, and 2025. Each one of those were good buying opportunities. And that's just the way, again, wasn't the exact bottom, right, this to the day, but got you in pretty close. Got you out, if you paid attention to it, at about the right time. A little early, maybe a little bit late, but you still got out on time. The other side of this coin, though, is price. So again, price is a reflection of what investors are doing in the market every single second of every single day. And one of the questions I get a lot is, Well, how do you know what do you mean stocks are overbought or oversold? Because there's an old saying that for every transaction there's a buyer and a seller. And that's a very true statement. You cannot have a transaction without a buyer and a seller. But there's a key ingredient to that, which is the price. If the market's just traded every day on this assumption that for every transaction there's a buyer and a seller, the price would be absolutely flat in the market. The market would not go up or down. But obviously the market doesn't do that. Market goes up and down all the time. So the question becomes, if for every transaction there's a buyer and a seller, it has to be determined by what price does that transaction occur. What determines the price? The price is determined by the demand between the buyers and the sellers. I've got a chart of this, a very simplistic chart to explain this. And what this table kind of shows you is that think about two rooms. And in one room, you've got 25 buyers. In the other room, you've got 25 sellers. At a certain price, there's 25 buyers or sellers, and there's only one buyer or seller for that transaction. So in other words, if I've got 25 people wanting to sell a stock in a room and one person willing to buy, you're not near a low yet, right? But the stock is oversold. You've got just people just wanting to get out of the stock, right? If the price begins to rise for whatever reason because another seller enters the room and says, okay, I'm willing to buy, right? Then sellers go, okay, well, I'm getting a better price than I was, so I'll sell, right? But as the price rises, you start running out of the people that have sold in that room. You're in the room full of sellers. Eventually, all those individuals will have sold what stock they wanted to buy. So now you've got a lot of buyers over here willing to buy stock, but there's nobody willing to sell the stock here for a couple of reasons. Sentiment being one of them is that, well, I'm afraid to sell because the market's going up. I don't want to sell here because I'm going to get a higher price. Or I've already sold all the stock I'm going to sell. So you simply just run out of buyers, run out of sellers. And the same occurs at the other point, which is now I've got everybody wanting to buy, and then sellers show up. And so all of a sudden, I've got people willing to buy, but I've got more sellers entering the room. And so the buyers go, okay, well, I'll buy your shares, but I'm going to buy them a little bit lower price. They were at $20 a share. I'll buy it at 18. And so the price starts to come down. And as the price starts to come down, you start getting more and more sellers and less and less buyers. So this is why, Brent, this is why markets move up and down over time. It's always a function, yes, for every transaction there's a buyer and a seller, but at what price? And that's driven by the supply-demand imbalance. So we can map this through technical analysis, and we can measure these price imbalances. And so we created internally a technical gauge, but this technical gauge is a composite of tools that are readily available to you. Relative strength, stochastics, momentum, Bollinger Bands, those type of things, standard deviation. All we did was take them all and just put them into one index. And so instead of measuring these on having 15 different indicators on a page, we just have one index to pay attention to. It just combines all these together. And the goal of that is if I can get confirmation of price action through multiple indications, I've got a better signal than just having one indicator. That's the premise or the theory. And so we created this gauge. It's our technical gauge, which comprises all these indications. And when, just like with the sentiment index, when this gauge is above 80, you're typically near a market peak. Things are getting very optimistic. When it's very low, it's below 30, you're starting to get close to bottoms. And when you're below 10, you are really close to a bottom, if not the bottom. And what you'll notice is that in April, We got down to 7. Now, 7 is an extremely low number for a technical gauge. And this is a weekly gauge, by the way. This is not daily data. This is weekly data, so it moves a lot slower. To get to 7, that was basically at the same level we were in 2020 in the midst of the pandemic when we shut down the entire economy. It's near the low in 2018 when the Fed was nowhere near neutral rates and the market was declining and there was a big fight between the White House and the Fed. We had the trade war going on with China. The only times that we were lower than 7 was at the bottom of the dot-com crash and the financial crisis. So when this was one of the key reasons we wrote the article, The Hope and the Fear, on April the 7th, was because you don't see readings like that outside of market bottoms. It was such an extremely low level that it just kind of rang alarm bells. Right now, we're back kind of in the middle of the range, which suggests that markets are going to go higher. We're not overbought yet on a technical basis on those levels. So these two indicators. So now we've got price and we've got psychology. And if we can marry those two together and we're getting similar readings on both, that's a really good indication that probably the dip, buying the dip, is closer to a low than not. In other words, you've mitigated the risk of buying a falling knife to a large degree. Now, again, if we go back, just real quick, Brent, let's pull this one gauge back up real quick for me. So if I go back to the technical gauge here just real quick, if I'm in the middle of this and it's decline, if the technical gauge is declining, right, and we've gone from, say, 80 or 90, we were really overbought, and we're at 50, 60 on the way down, that's not the opportunity you're looking for to buy the dip, right? You're in the middle of a correction, right? So just like I said with sentiment, it works the same way with technical. In the middle, the herd is right. They're wrong at the extremes. So if you're in the middle of ranges on whatever technical tools you're using, so if you're using, your own set of technical gauges, whatever it is, you're using RSI, Relative Strength Index, or you're using a MACD, or you're using some other variation of technical tools. If you're in the middle of the ranges, you're not at the lows. You're still in the corrective process. But if you start reaching extremes on those indexes, that's where you're starting to near market lows on multiple bases. So again, then if you can combine whatever tools you're using on a technical basis with measures of sentiment, and you get both of those to confirm each other, you've got a really good opportunity that you're probably near a market low or a peak. This works in both directions. The problem with buying the dip is that it's not an easy thing. Because, again, we fall victim to our own psychology, right? So which is interesting, right? Because we're looking at sentiment, we're looking at how bearish everybody is, and then our own bearishness kicks in and says, well, I can't buy here because of all these reasons, right? Markets might go lower, it's loss avoidance, etc. But this is why being a contrarian investor is so very difficult, because at the moment you're the most scared to buy the markets is exactly when you need to be buying the markets. And that's the hard thing to do. It's hard for everybody. It's hard for me. It's hard for you. It's hard for everybody. There's no easy way around this, right? But those opportunities come. The two biggest problems that we have as investors is psychology and patience, because we're not willing to be patient and wait for the opportunity. We're not willing to be patient, take profits at a peak, and then be patient to wait for another opportunity. We're too worried about missing out, right? Patience is critical for successful investors. All right, we'll come back, wrap up the show. That article on the website now, realinvestmentadvice.com. It's also on our Substack page at Lance Roberts on Substack. Be sure to subscribe there. We post all our articles there every day. Be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Declare your financial independence from the mainstream financial media and join us for the next RIA Candid Coffee with Danny Ratliff and Lance Roberts, Saturday, June 28th. Know the enemies of your wealth and fight them on your terms. We'll arm you with the information you need. Register today for the Financial Independence Edition of Candid Coffee, Saturday, June 28th with Ratliff and Roberts at realinvestmentadvice.com. realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. So let's get ready to wrap up the show. Futures are flattish this morning. Everybody's just kind of waiting for this week. We've got CPI coming out on Wednesday, PPI out on Thursday. So you'll have a couple of inflation reports. Then, of course, everybody will try to figure out what that means for the Fed. Will they cut rates? Won't they cut rates, et cetera? So markets will probably just be a little bit tentative over the next day or so. Markets are pushing up into a little bit more overbought condition here. Again, just, nothing to be overly concerned about. Just price gains are going to be a little bit more muted than they've been, really here over the last, month or so that we've had, that rally off that April low was very strong. Interesting, Seagate Technology is a good example, is up like 98% from that low. It's had just a phenomenal run, but there's a lot of stocks up more than 50% from that low. Palantir, Western Digital, quite a few others that have had just very, very big moves, more than 50% from those lows. As retail investors just really just piled in to kind of their favorite stocks that they can move with the markets, kind of more high beta names. So we've seen a lot of that action here over the last, couple of weeks. But we're about to head back into earnings season. So a couple of things are about to happen. First of all, starting really on Friday, but really next week, the window for stock buybacks begins to close. So one of the big supports for the markets here over the last month or so has been this return of corporate buybacks. We came out of earnings, and then that window opened back up, and then we've seen a lot of support for the markets from share buybacks here over the course of the last month, and that's really helped lift the market a good bit. That window is going to start closing next week because as soon as we get to the end of the month, corporate earnings again. So we right back into the whole, what's Microsoft going to say, what Apple's going to say, blah, blah, blah. So it's just part of the cycle we go through every quarter, but it's as soon as it ends, we begin it again, it seems like. So we've got that going on. So that could put a little bit of cap to the current market run. Again, headlines out of the White House, out of the administration can certainly, on trade, there's a couple of meetings coming up. We've got the G20, some other meetings coming up here. So there's going to be more of the trade talk, negotiations, those type of things. We'll start to hear some more about that. I would expect if we're going to hear about some trade deals getting done, that's going to probably come around the G20 summit, somewhere around there. So we've got a few things that are coming that could certainly put a little bit of pressure on the market. So again, I'm not saying that, it's all clear here. Markets are low, but again, as we were talking about earlier, we're in the middle of the ranges for these indicators, right? So sentiment is in the middle of the range. The technical gauge, kind of the middle of the range. So the herd is right now. So don't fight the herd here at the moment because they're right. We're not to the extremes yet. But one thing that's coming up is earnings. And I published an article on Friday. And again, so if you go realinvestmentadvice.com or go to our Substack page at Lance Roberts, either one, I posted an article on Friday talking about, does consumer spending drive earnings? And the short answer to this is yes, it does, because that's where earnings come from. You and I have to go out and spend money. We buy a product. That product creates revenue for the company. That revenue is then used to create more product, pay salaries, payrolls, benefits, all those type of things, and then they wind up with earnings at the bottom. So we go through this. And so one of the key things, if you want to know where earnings are going, right? Because why are earnings important? Markets have a very high, the annual rate of change of markets is very highly correlated to the annual rate of change of earnings. Because why? We pay for earnings. So if you want to know where earnings are going, take a look at where personal consumption expenditures are going. Here's a chart. You'll notice that there is a decently high correlation between the direction and trend of personal consumption expenditures and the direction and trend of earnings. We are seeing some early evidence that the consumer is beginning to slow down. Credit delinquencies are on the rise. Defaults are on the rise. Those type of things. We are seeing some stresses on the consumer. If personal consumption expenditures slow down, and again, why would they slow down? Because employment growth is slowing down. People are more concerned about keeping their job, like Brent. If you're concerned about keeping your job, what do you do at home? You cut back a bit. If you're already struggling to make ends meet and you're worried about your job, you really start trying to cut back a bit here. That's just kind of consumer psychology. So employment growth in the last report on Friday, 139,000 jobs. Great. Nobody pays attention to revisions. The previous 2 months were revised down about 70,000 jobs. That 139,000 job report will be revised down next month. Don't know how much, but it'll be revised down. Might be closer to 100,000 jobs. Importantly, though, the 3-month rate of change in employment is slowing. If that rate of change continues to slow, again, that's not necessarily recessionary, right? But it does suggest the economy is indeed slowing down. And if the economy is slowing down, consumers are spending less. That's why the economy is slowing down. It's not the economy slows down and then consumers decide to spend less. The economy is slowing down because consumers are spending less. And we see that in the personal consumption expenditures, the rate of change of it. If that continues, earnings are going to weaken. If earnings weaken, so do annual stock returns. Now, that doesn't mean the market's going to crash. Don't take what I'm saying here and go run out and say, Lance said the market's going to crash, because that's not what I'm saying. I'm saying that the annual growth rate of the market will slow. So we had 2 years in a row of 20% returns. It was like, wow, this is great. It's fantastic. In January of this year, I think it was January the 7th, something like that, we wrote the article called Curb Your Enthusiasm. We said, hey, expect a year where returns are going to be with a lot of volatility. And guess what? So far, returns have been and you've had a lot of volatility. That's likely going to continue this year. I mean, we could still finish this year up 7, 8, 9%, right? Well short of 20% from last 2 years with a lot of volatility. But just if we're starting to see slower economic growth and that translates into slower earnings growth for stocks, that is going to lead to lower rates of return in the future. Now, this is assuming that everything else remains status quo. We don't have the Fed come in with massive rate cuts and restart QE, nothing like that, right? So assuming the Fed stays where they are, which there's no reason they shouldn't right now, stock returns are going to be lower next year. Probably somewhere 6 to 8%. Still not bad. I mean, but again, when we're talking about, we've gotten very used since 2009. We've been cranking out 12% rates of return in the market on average since 2009. That is 50% more than the average rate of return of stocks from 1900 to 2007. The reason you got that 50% increase in stock returns in the last 15 years versus the previous 120 is because, 107 is because of all the artificial interventions, HAMP, HARP, TARP, QE, zero interest rates, all those type of things. Assuming the Fed stays where they are, doesn't cut rates dramatically, you don't have QE, we don't have big spending programs in the economy, which we don't right now. We don't have any more CHIPS Acts or those type of things. Assuming all that remains the same, stock returns are going to return to normal, which would be 6 to 8%. That's going to be very disappointing for a lot of investors, even though that's normal. But this is how, I was talking about at the open of the show today, how we've all gotten used to zero interest rates and, everybody talks about housing unaffordability. Well, it's because you had zero interest rates. You created an anomaly in the markets due to zero interest rates. Interest rates should have never been zeroed by the Fed, right? You should never have had a 2%, 3%, 30-year mortgage. That should have never occurred. Nobody in their right mind is going to loan money out for 30 years at 3%. That makes no sense whatsoever, but we did it. So you created this housing problem. Now, you've got 500,000 more sellers than buyers, but they're not willing to drop the price yet because everybody's hanging out, waiting for an opportunity. Now, I'll tell you that a lot of the national statistics are wrong on housing, right? People say, I can't afford to buy a house. Yes, you can. I just ran a search this weekend. I'm looking to start buying some rental properties. In the city of Houston, there's over 300 properties right now that are very affordable for somebody making $40,000, $50,000 a year. There is almost 100 properties in bankruptcy, pre-bankruptcy, or outright foreclosure, just in the city of Houston. So if you're not thinking that the economy is slowing down, pay attention to what's happening with debt, because there's a lot of action in the debt markets that hasn't shown up yet in the financial markets. Anyway, wraps up the show for today. Be back tomorrow with John Penn, Two Dads on Money. See you back tomorrow morning. Get by our website, realinvestmentadvice.com. Also, get to our Substack page at Lance Roberts, Twitter at Lance Roberts. We post everything for you every day. This show included live on X every morning, YouTube, everywhere. See you tomorrow.